Welcome, everyone. So, in our past sessions, we've really dug into the income statement and the balance sheet. Today, we're going to connect them with what I believe is the most honest of the three core financial statements, the statement of cash flows. Now, this isn't just about crunching numbers. It's about learning to see the reality of what's going on inside a company. We're going to learn how to read the story that cash tells us, and you'll soon see that story can be dramatically different from the one told by profit. All right, let's kick things off with a puzzle, a question that really gets to the heart of why this topic is so critical. How is it possible for a company to report fantastic profits quarter after quarter and then suddenly be on the brink of bankruptcy? And I want to be clear, this isn't just a trick question for an exam. This happens in the real world, and it has brought down companies that looked from the outside like they were flying high. The answer is all about the difference between profit and cash. And by the end of our session today, you're going to understand that difference inside and out. So, where does this whole puzzle start? It starts with the core accounting principle that we've touched on, but now need to really master, accrual accounting. You see the definition here? We record revenue when it's earned, not when the cash hits the bank. We record expenses when they're incurred, not when we pay the bill. Now, why do we do this? Well, it's all about something called the matching principle. We want to match the cost of doing business with the revenues those costs help to create in the same time period. This gives us a much better picture of a company's performance, but, and this is the big but, it creates a gap, a timing difference between the profit we report and the actual cash we have. And it's in that gap that companies can get into serious trouble. And that brings us to maybe the most important idea for today. I want you to think of it like this. Net income is like your grade on a report card. It tells you how well you performed over the semester. But cash flow, that's the actual money in your pocket to buy food, pay your rent, and keep the lights on. You can have a great report card, but if you don't have cash for your immediate needs, you've got a serious problem. A business can perform well on paper, but without enough cash to meet its day-to-day obligations, paying employees, suppliers, rent, that performance means nothing. Performance is great, but survival is everything. Okay, so if we know there's a gap between performance and survival, how do we measure it? How do we get from one to the other? Well, that's exactly what the statement of cash flows is for. It's the bridge that connects the net income from the income statement to the actual change in cash on the balance sheet. And when we prepare it, there are two main ways to do it, two paths we can take, the direct method and the indirect method. Let's look at these two side by side. The direct method is pretty straightforward. It's like looking at a bank statement. It literally lists out cash received from customers, cash paid to suppliers, cash paid to employees. It's intuitive, but it doesn't really tell you why the cash is different from the profit. The indirect method, which is what we're going to focus on, does something really powerful. It starts with net income and then makes a series of adjustments to walk us over to the actual cash flow. Now, there's a reason over 95% of companies use this method. It's because it tells a story. It doesn't just give you a number. It explains exactly why profit and cash are different. It's an explanation, not just a list. All right, let's get into the weeds. We're going to decode the logic of the indirect method. I really want you to think of this as a puzzle we're solving together. Don't just try to memorize rules. For every adjustment we make, there is a clear, logical reason why we're making it to get from that accrual number, net income, to the hard reality of cash. The very first adjustment we need to understand is for something called a non-cash expense. And the classic example here is depreciation. Now, remember the matching principle. When a company buys a big, expensive machine, it doesn't just expense the whole cost in 1 year. Instead, it spreads that cost out over the machine's useful life. That annual expense is called depreciation. It reduces our net income on the income statement, which is correct from an accrual perspective. But here's the key. No cash actually leaves the building when we record depreciation expense. The cash left years ago when we bought the machine. So it's an expense that affects profit, but has zero impact on our cash balance in the current year. This brings us to a point that trips a lot of students up at first, but it makes perfect sense once you get it. Okay, think about it. The indirect method starts with net income. By definition, net income has already had depreciation subtracted from it to get to that bottom line. But we just established that depreciation is a non-cash expense. So to get from our profit number to our cash number, we have to reverse the effect of any non-cash items. Since we subtracted depreciation to get to net income, but no cash actually went out the door, we have to add it back. We are simply canceling out the effect of a non-cash expense to get a clearer picture of our true cash flow. So here it is, our roadmap for the operating section of the statement. It's a simple 3-step process. Step 1, we grab our net income from the income statement. Step 2, we add back those non-cash expenses we just talked about, like depreciation. And step 3, we adjust for changes in what we call our working capital accounts. Let's dig into that third step right now. This last set of adjustments is all about timing. It deals with changes in our current operating assets and liabilities, things like accounts receivable and accounts payable. These accounts are the perfect examples of the timing differences between doing business and actually moving cash. For instance, if your accounts receivable goes up, what does that mean? It means you made a lot of sales on credit, but you haven't collected the cash yet. That's a use of your cash. On the flip side, if your accounts payable goes up, it means you've bought goods from your suppliers but haven't paid them yet. That's a source of cash for you, like a short-term loan. Understanding how these accounts change is absolutely crucial to seeing the full cash story. Okay, theory is one thing, but let's make this real. We're going to walk through a scenario to see how everything we've just discussed plays out when a real business decision has to be made. For the next few minutes, you are no longer students. You are the manager of a business. So here's the situation. You run a coffee shop. It's been a great year, the place is always busy, your customers are happy, and you just got your income statement from the accountant. And look at that, a $50,000 profit. You're feeling pretty good, right? Successful. And you're already thinking about ways to reinvest that profit and grow the business even more. But being a smart manager, you know to look beyond just one number. So you look at some key balance sheet accounts. For simplicity, let's say inventory and what you owe suppliers stayed the same. But look at accounts receivable. Wow, it jumped from $10,000 to $50,000. What does this tell you? It means a huge chunk of that profit came from sales, maybe big catering orders to local offices, that you've earned but you haven't been paid for yet. That $40,000 increase is profit on paper, but it's not cash in your bank. And right on cue, a salesperson comes in with a proposal for a brand new, top-of-the-line espresso machine. It would be amazing for your business. The cost, $30,000. So here's the decision you have to make. You look at your $50,000 profit, you look at the $30,000 price tag, and your gut instinct is probably screaming, yes, of course I can afford this. But what does the cash story tell us? Now we apply the logic we just learned. We start with our $50,000 net income. Then we look at our working capital. The rule is an increase in an operating asset like accounts receivable is a use of cash. That $40,000 is cash tied up with your customers, not available to you. So we have to subtract it. $50,000 in profit minus the $40,000 increase in receivables, and suddenly we see the reality. Your business only actually generated $10,000 in cash from its operations this year. So can you afford the $30,000 machine? The answer is a clear, definitive no. Not with cash, anyway. Your profit was high, but your cash is dangerously low. Think about it. If you had made that purchase based only on the income statement, you could have driven your business into the ground, unable to pay your rent or your baristas next month. This simple analysis, this reconciliation of profit to cash, has just saved your coffee shop. This coffee shop scenario is a perfect illustration of what we're learning today. So let's step back and summarize the big lessons here, the takeaways that you absolutely must carry with you into your careers. Whether you're in finance, marketing, operations, it doesn't matter. I want you to burn these common mistakes into your memory because avoiding them is what separates a good manager from a great one. First and most importantly, never ever confuse profit with cash. We've seen how dangerous that can be. Second, don't get tunnel vision on the income statement. You have to look at the balance sheet to see what's happening with accounts like receivables and payables. Third, never make a major spending decision without understanding the cash flow implications. And finally, always remember to account for those non-cash items like depreciation that create a wedge between profit and cash. Getting these things right isn't just about passing this class. It's about making smart, sustainable decisions in the real world. There's an old saying in finance that sums up our entire discussion perfectly. Profit is an opinion. Cash is a fact. Now, why do we say profit is an opinion? Well, because it's based on a set of rules and estimates. When do you recognize revenue? How long will a machine last? These are management's subjective judgments. They're opinions. But cash? Cash is a fact. It's either in the bank account or it isn't. There's no debate. And at the end of the day, facts are what determine if a business survives or fails. So as we wrap up, I want you to think of the statement of cash flows as more than just a report. It's a new lens. It's a way of thinking critically and looking past the headlines. The next time you read an article about a company reporting record profits, I hope your first thought will be, that's interesting, but what does the cash flow say? This skill, the ability to read the true story of cash, will empower you to uncover the reality behind the numbers. In our next session, we'll take this framework and apply it to real public companies and see these principles in action on a much larger scale.